Thanks for clicking. The Bank of Canada is set to raise interest rates next month, with many saying that a 75 basis point rate hike is almost guaranteed, especially after the Federal Reserve raised rates by 75 basis points last week.
We got no choice.
With Canada's real estate prices down 13% since February, further rate hikes and increasing mortgage rates are likely to continue to put more and more downward pressure on Canada's real estate market for the foreseeable future. And we saw major increases in mortgage rates this month, almost 1%, which is going to put even more pressure on affordability for Canadians. So what I want to do today is look at the best mortgage rates, especially compared to last month, as the speed of the increase is definitely a little startling. Then I want to take a look at how mortgage payments have changed to get the average home in Canada, as affordability has reversed since we looked at rates last month. Then we'll take a look at what to look for next. We're set to receive Canada's inflation data this Wednesday, which will obviously have a big impact on the Bank of Canada's rate hikes going further. We'll obviously have an update out on that inflation rate on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into these mortgage rates. Onto the mortgage rates. The best 5-year insured mortgage rates have gone up substantially over the past few months. In insured mortgage rates, remember, that's where you put less than 20% down. You qualify at either 5.25 or 2 points above the contract rate on a 25-year amortization. The best mortgage rates as of April was 3.99, which went up to 4.19 in May, and then went up quite a bit to 4.99 in June. So we saw a 0.8% increase in just a little over a month, and a 1% increase in the past 2 months alone. And 5-year insurable mortgage rates also went up. Insurable mortgage rates are where you put 20% down, but you don't pay the mortgage insurance, but you still qualify in the same manner as though you were paying the mortgage insurance. So 25-year amortization and 2 points above the contract rate, or 5.25%, whichever is higher. The best 5-year insurable mortgage rate in April was 4.19. That went up to 4.54 in May, or 0.35 higher, and then shot right up in June to 5.39, or 0.85 higher than it was a month ago. So even if you put 20% down and you don't pay the mortgage insurance, you're still paying 0.85% higher than you were at this point in time last month. And these increases in rates also showed up in the uninsurable mortgage rates. If you remember, uninsurable mortgage rates is where you put 20% down, but you have a 30-year amortization, or when you refinance your house. When you take money out of your house, that's also considered uninsurable. Those rates have also gone up over the past few months. In April, the best 5-year uninsurable rate was 4.29. That shot up by 0.45 in May, up to 4.74. And that's gone up again in June, up to 5.39, or 0.65 higher. So mortgage rates are up all across the board, up almost 1% since this point in time last month, and up almost 1.2% since this point in time in April. But what has this done to affordability? With real estate prices down all across Canada, has housing become any more affordable? If we look at April's average house price of $746,000 with minimum down payment requirements and a mortgage rate of 4.19, the payment was $3,899. Now, if we look at May's average house price of $711,000 and use that 4.99 interest rate, that payment goes up to $4,038, or about $150 more per month to get that average house price in Canada. If you remember, last month the situation was reversed. Mortgage rates had gone up, but not by as much. Buyers were paying $160 less for the average home than they were in April. Mortgage rates had not quite caught up to the drop in house prices. And this situation with affordability is going to ebb and flow going forward. As house prices drop and mortgage rates rise, we're going to see affordability go up and down as this goes on. And it's also likely that this situation is going to go on for some time. With the U.S. inflation rate coming in at 8.6%, and U.S. Treasury Secretary Janet Yellen saying that inflation is going to continue on for the remainder of 2022, It's likely that the Bank of Canada is going to continue on with these rate hikes, at least for the foreseeable future, and mortgage rates are likely to follow. Though the Federal Reserve's decision to raise rates by 75 basis points is definitely going to weigh heavily on the minds of the Bank of Canada, they'll also be looking at our inflation rate, which, like we said, is set to be out on Wednesday. And the higher that inflation rate goes, the longer and more severe our own interest rate hikes will be. We'll obviously have updates out on that inflation rate on Wednesday. If you want to get those updates, make sure you click like and subscribe. And thanks so much for watching.